equities are still cheap relative to any other asset class.
But they're not.
I would say that single-family homes are cheap now, too.
You would?
Yeah, single-family homes. If I had a way of buying a couple 100,000 single-family homes and had a way of managing, the management is enormous. It was really a problem because they're one by one. They're not like apartment houses. So, but I would load up on them, and I would take mortgages out at very, very low rates. But if anybody is thinking about buying homes, 5 years ago they couldn't buy them fast enough because they thought they were going to go up, and now they don't buy them because they think they're going to go down, and interest rates are far lower. It's a way, in effect, to short the dollar because you can take a 30-year mortgage, and if it turns out your interest rate's too high next week, you refinance lower, and if it turns out it's too low, the other guy's stuck with it for 30 years. So it's a very attractive asset class now.
If you are a young individual investor at home and you have your choice between buying your first home or investing in stocks, where would you tell someone is the better bet?
If I thought I was going to live, if I knew where I was going to want to live the next 5 or 10 years, I would buy a home and I'd finance it with a 30-year mortgage, and it's a terrific deal. And if I was an investor that was a handy type, which I'm not, and I could buy a couple of them at distressed prices and find renters, I think that's, and again, take a 30-year mortgage. It's a leveraged way of owning a very cheap asset now, and no, I think that's probably as attractive an investment as you can make.
So I thought it was good to start off with a video there of Warren Buffett, because there's only 3 things we're trying to achieve today. The first one is to decide whether there's an opportunity in America. The second one is to decide what is the opportunity. Is it houses, is it apartments, and where to invest? And the third one is that without management, there is no investment. Would we agree with that? So, like he said there, it's a great investment if he can get a couple of 100,000 houses if he could manage them. And most importantly today, if we can answer those 3 questions for you, then we believe we've achieved our objective. Is that fair? So, just saw a couple of hands. For those of you who know IPS, please just bear with me for 2 minutes, because I think it's quite important to just frame up who we are, where we come from, what our story is. Most importantly, I'm actually a Durban boy. I studied construction management at UCT. I went across to London. I worked for an Irish developer for 5 years. I bought my first house in South Africa at the age of 22. I bought my first house in London at the age of 24. And I did my first development at the age of 26. Now, I don't tell you that to be arrogant. I tell you that to show you that all I've ever done is property, international property, and I'm passionate about it. Now, what really happened with me was at the age of 26, I was buying quite a few properties back in South Africa and in the UK, and I got really, really pissed off with how difficult it actually was to deal with the banks, to deal with the lawyers, to deal with the estate agents. And so I thought to myself, well, there's a real need here to help people invest internationally. So in 2003, we set up IPS, International Property Solutions, and since then we've helped over 2,000 people invest internationally to a value of over 1.6 billion rand. And I think what's most important for us is that what made no sense to me was that there's fantastic estate agents here in Bryanston, and they sell a wonderful house 6 days a week. But it made no sense to me that on a Sunday they sold you a house in London. Does that make sense? So all that we do is international investment. That's our niche, that's our focus, that's what we're good at. We've got offices in South Africa, Australia, the UK, and America. We spend millions on research each year. I think it's quite important to explain to you quickly the story of America. So we were helping people invest in South Africa. Then people here, we were dealing with all the property players, and they wanted us to help them invest in London, so we did that. I came home at the back of 2007 for 2 reasons. One reason was for lifestyle. 9 years in the rain, as Ryan mentioned, is not that much fun. The other one was for business. I really believe there was an opportunity to help people invest internationally. But we found for every 2 people who came through the door, one wanted London, one wanted Australia. So we got Australia up and running. But it's important to understand that to get South Africa and England up and running was easy. I'd invested there, I'd lived there, I knew the market. Australia, it took 4 trips in 1 year until we actually started investing. We're not one of those companies that decides, oh, there's a good opportunity with a lack of commission in Brazil, we'll sell Brazil. Does that make sense? We wanted to get into America, and to be fair, we all know that where chaos, there's opportunity. So I flew to America with my wife in January of 2010 for 5 weeks. I actually sat in a presentation very similar to the one you're in 2009, and from some people, pretty respected people that I knew. And I was very impressed by what they said. The property sounded good. It sounded cheap in comparison to the prices. And most importantly, you know, there's a FedEx thing going to be there, et cetera, et cetera, et cetera. But we never invest in anything unless we actually go and see it. So we flew over in January 2010. And just to put it in perspective, I flew to Tampa. I said cheers to my wife. You know, leave her in the bed and breakfast for 2-3 hours. Is that reasonable that you're going to take about 2-3 hours to look at a property? Yes, no? Okay, well, they put me in a car in Johannesburg and drove me to Port Shepstone. I'm not exaggerating. I'm really not exaggerating. We left at 9 o'clock in the morning and I got there at 6 p.m. in the evening. Then they had the Atlantic Brave star come, the pitching guy. It's like John Smith coming along to the meeting. But to be honest, I don't know anything about baseball, so it didn't mean anything to me. While they were off having coffee, they made one fundamental mistake. They left me with a sales agent. And I said to the sales agent, tell me about the numbers. She said, there's 126 units. We've sold 10. I said, interesting. How many of you sold in the last year? None. How many of you rented in the last year? None. And that, basically, I literally put my tail between my legs. I decided that the Americans would rather sell their sister than you know, they'll do anything to make a deal. And we could not find partners on the ground we could trust, and we flew back to South Africa in 2010. For 2 years, we watched from the sidelines. A good friend of mine, Brendan, who's in the room, actually purchased a property in September of 2011. And again, we watched, we listened, we wanted to understand the opportunity. And then funny enough, as most good business decisions are made, it was over a beer at Forrey's pub in Cape Town. And myself and Neil Peterson, the owner of Real Estate Investor magazine, and Brendan, we're discussing America, and we were like, come, it's time to go back to America and go and check it out. So we pulled our resources and we flew over to America. Long story short, we went with a different strategy. You know, I'd worked with a guy from England, a CA, helping British and Irish people invest into South Africa for a long time, back since 2005. I liked him, I respected him, and I trusted the fact that he liked to look after his clients. So in January, we phoned him and we said, listen, January last year, we said, how many people have you helped invest in America? And he said, we've helped 1,100 British and Irish investors invest in America over the last 6 years. And I wasn't really interested in the discounts, but I was very impressed by the yields and the vacancy rates and the partners that they had on the ground. So what actually happened was that Neil and Brendan and myself flew to America, and we did 8 cities in 11 days. Now, we're not stupid. I understand that you can't arrive in Johannesburg in one day and decide whether this is a good market or not. But with all due respect, we weren't trying to do that. We were going to meet you on the ground. Do we like you? Do we trust you? Do you have the experience? And can you execute on the opportunity? Is that fair enough? Obviously, from there, we've whittled it down. And I think what's really important is that today we're going to show you 3 areas. But that doesn't mean we haven't investigated 14 other areas. I personally have investigated New York, Boston, Chicago, San Diego, Phoenix, Vegas. Which ones am I forgetting? Miami. Anyone else, Brendan? What else are we forgetting? No, the Memphis, Atlanta, Orlando is obvious. They're here. But I'm just trying to say to you that, you know, it's not a case of we just bring in the markets we went to look at. We've looked at all the markets. And if you want to, in the FAQ at the end, I'll tell you the pros and cons of why we chose different areas. But the most important thing that I wanted to point out was that I've lost my... There. The most important thing I wanted to point out is I actually calculated we've spent 1.1 million rand in the last 12 months flying to America, flights, accommodation, car hire, dinners, entertainment, shows in Vegas. But with all seriousness, that's the hard cost that we've spent this year, just this year in the last 12 months, understanding the American market. So you should all have a USB. Have you all got a little USB? Okay, you guys paid 100 rand for that USB. It cost me 1.1 million rand to give you that USB. Because everything on there is the research that we've accumulated from all our partners. We've literally given you everything we've got. I truly believe if you're interested in America, that USB is worth more than anything. Whether you invest with us or not doesn't bother me. It'll still be valuable. I believe the greatest value we bring to the table is actually our best-of-breed partners. You cannot succeed in a foreign country without a partner on the ground that you trust. It's impossible. I guarantee it. And if you think I'm wrong, good luck, and we'll talk in 2 years. I'm not being arrogant. I'm just telling you from over 2,000 transactions. It's the only way to do it. And what I think we, with our experience, really pride ourselves on is being able to find those guys quite quickly. So, you know, even though we went back to America multiple times, We believe now we've found people on the ground that we can fully trust. They had a track record with the British and Irish in terms of international investors and everything else. We've now been through the ringer with them. We love our IT in terms of, someone actually said to me in Durban, I don't know if I should tell you this, I personally don't think degrees are worth a hell of a lot. Your results are much more important. But I do have an honors degree and a master's degree in IT, so we use that a lot. I do believe the after-sales division is probably our greatest asset. I don't know if Kristen's in the room, but Kristen and her team, for me, most people think that just buying the property is the hard work. We think that buying the property is 20%. We believe that the purchase management, the after-sales, the management, and the maintenance is actually 80%. And unfortunately, what most people in our industry do is they focus on the sales, and once you've got the property, it's good luck, Joe, you're on your own. Am I right or wrong? Kristen and her team, and you'll hear from some people today, are extremely professional at holding your hand through that whole process. And the best way to describe it is when I came back to South Africa, I wanted to get a banking account going and everything else. And there were basically two options. And I was with Standard Bank since I was 13 with my Order Plus. And this is not bashing Standard Bank, but you could walk in and every day you'll deal with a different teller. And it's frustrating. Or you can go to Investec and you deal with one person and they sort out all your problems. Am I right or wrong? Okay, well, we provide the Investec experience. If you want to deal with the Standard Bank experience, that's awesome. We're just not your person. Because we want to help you hold your hand through the process, one single point of responsibility, the best level of professionalism service we can provide you. We've got access to off-market opportunities. You're going to see quite a lot of those today. And I think the partners will explain in terms of why it's happening and what is happening. And just in terms of that, a lot of people say to me, I am going to answer it in the FAQ as well. But I will answer it for you where people say to me, well, why are you doing this? So don't worry, I'm going to answer that for you in the FAQ in terms of so that you can understand it. We were the very first company to be a member of the ARPP. It stands for the Association of International Property Professionals. It's a bit like the Estate Agents Affairs Board. It just runs out of London quite a bit more efficiently. And basically, it regulates international property transactions. We were the very first company in South Africa. I'm not sure if anyone else has been invited, but anyway, we were the first. And then I also qualified last year in CRS, which is Certified Residential Specialist, which is the highest property qualification you can get in America and arguably the world in terms of actually. So again, I'm not that interested actually in qualifications. I'm much more interested in results, but some people in this room are impressed by that stuff, so I'll just tell you. There's 5 reasons for me why I personally don't just invest in South Africa, I also invest out of South Africa. Now for me, you must understand my background. I'm half Zimbabwean. My father's side is Zimbabwean, and we had 3 farms. And the other side of my family is South African, and we've been farmers in the KwaZulu-Natal since the 1800s. And for me, a very interesting story was my uncle lived in Zimbabwe, and for him, it was a case of, it's a fantastic lifestyle. I'm absolutely passionate about Africa. I love living here. But you've got to have, in my mind, a plan B. Now, I might be wrong. You guys might be right. People might disagree with me. But this is just my belief system, so I just want to share it with you. I like to believe from personal experience. So my uncle decided in 1980, at the age of 30, that he would at least have a plan B. And so while he was making good money in Zim, he was also creating assets and money offshore. He opened his offshore bank account. And he's not an arrogant man. And he said to me in the 90s in Zim, it was easier to make money than print confetti. But the difference was, there's plenty of guys in Zimbabwe that didn't just live the high life. Others took action and took a plan B. And in 2003, when nothing to do with his business or making money, but actually because of his 6-year-old son, the teacher kept changing and there weren't dentists and everything else, he had the flexibility and the freedom to say, right, I want to move to Brisbane. So he moved to Brisbane. He bought a house for cash, $1.8 million. He put his kid through a private school. And most importantly for me, he didn't have to work for an Australian. You have no idea. I meet plenty of Zimbabweans in Australia. The one guy said to me, I used to be a general, now I'm a foot soldier. It's not fun when you've risen up in life and you go back down. Now, I'm not being negative. I promise you I'm not being negative. I hope that I never have to leave. But what that story taught me was that if you have plans, you have flexibility. And if you have flexibility, you have freedom to make whatever decisions you want. If you want to live in Africa for the rest of your life, awesome. But the bottom line is you get to have that choice. So for me, there's 5 things that caused me to really look overseas aggressively. The first one was the rule of law. I'm sick and tired of kicking my tenants out of properties here in South Africa. I have a wife that is a property lawyer, so technically I could do everything completely legally, but it's just a complete waste of time, frustration, and everything else. And believe it or not, in first world countries, I really don't understand why, but in first world countries, the rights of a property owner are protected. Jeez, you guys are a tough crowd, eh? You know, so for me, the threshold was actually June 2010 when the cops came to arrest me because my tenant hadn't paid for 4 months. She was an employee for FNB Home Loans. I just happened to have a home loan with FNB, and FNB said it's not my problem. The cops came to arrest me for putting a little security gate on her door. I was done with it. And the second one, and I don't want to go into a lot of detail on this, we all know what's happening in terms of the political and economic instability. The one that I'm really concerned about is that who hasn't heard of Clem Santa here? No, you have heard of Clem Santa. Okay, just for this gentleman, who has heard of Clem Santa? Okay, so we all heard of Clem Santa. The one thing with Clem Santa is that he's just, in the last year or so, been awarded the #1 person, or the top 3 people that have impacted South African business more than anyone else in the last 10 years. So can we agree that he's probably someone we should at least listen to? We don't have to agree with him, but we can at least listen to him. And what really scares me is that 3 years ago, I've watched this presentation probably consistently for about 3 or 4 years, and he's got 3 scenarios for South Africa. The first one is that we stay in the Premier Division, which is where we stay in the top 50 countries, life is great, and it continues quite similar to what we've been used to. The second one is where we go into the second division. And unfortunately, we're poor but peaceful, and quite a few of the middle class leave because they can't get education, they can't get jobs, they can't get access to health. And obviously the tax rate, the tax base drops dramatically. And the third one is where we go failed state. And unfortunately, that's Afghanistan, Zimbabwe, etc., etc. Now, what worries me is that 3 years ago, he gave us a 60% probability of Premier Division and a 40% probability of Second Division. In September, when Neil Peterson put on an event with Dolph de Roos and Clem Santa and Robin Banks, so this is September last year, he gave us a 50% probability of Premier Division, a 40% probability of Second Division, and a 10% probability of failed state. And when I did the webinar with him in September 3 weeks ago, he gave us a 50% probability of Premier Division, a 25% probability of Second Division, and a 25% chance of failed state. Now, for me, if someone told me I had cancer with a 1 in 4 chance, I would go see a doctor. Am I right or wrong? So again, I'm not being negative. I'm just pointing out what he's looking at and the concern. The third thing for me is what I call wealth preservation. And, you know, I'm a big believer in this country. We understand how important land is. I completely buy into land redistribution. I understand that in 1994, 95% of the land was owned by 5% of the population, and we need to rectify that. The question is how we do it for a sustainable future. And what worries me, and this is according to the Center for Constitutional Rights, a lady by the name of Nikki de Havilland, they're looking at the government's agricultural framework. There's been a commission appointed on foreign ownership, and there's also a draft policy on the expropriation bill. And the most important thing that they're looking at is the right to lawful, reasonable, and procedurally fair administrative action limps a weak third. Basically, they identify the land for redistribution. They're followed by a notice for expropriation. After it is expropriated, they take ownership and possession of the property. It is only after transfer of the property that the question of compensation is considered. There's 5 things that Nikki de Havilland, you can see there, she's the Deputy Director of the Center for Constitutional Rights. And if you're interested, there's all the details. Go and check it up yourself. There's 5 things that she's really nervous about. The state has effectively shifted the constitutional burden of cost of the land reform from the individual, from the state to the land to the individual. Secondly, it'll have an impact on the property market as a whole. Can we agree that if they take a farm in Pofadder, it'll affect the value of this building? Anyone disagree with that? please disagree with me. I'd like to have a debate. No? I just want to tell you personal experience. When I was in England helping British and Irish investors invest in South Africa, the moment the Zimbabweans started taking farms, they were like, you guys are taking your farms. We're like, dude, that's like Ireland is to England. They don't understand. Neither will we in our own country. The agricultural industry, it'll affect all the farmers because they won't be able to get finance on farms. It'll undermine the cooperation between the agricultural sector and government. And lastly, it'll undermine investor confidence, both local and international. So for me, that is something that is really, really concerning me that I've got my eye on. The fourth thing for me, and this actually just annoys me, is that 80% of South Africans or more that invest overseas actually lose money. That was research done in 2010. And that's not just property, that's shares, that's everything. And myself and Henny actually worked on this about 2 years ago to try and understand when this research came out, why that happened. And we believe the number one reason that that happened is that people make emotional decisions and they make crisis investments. Now, what is a crisis investment? A crisis investment is the rand is dropping and you're going on a business trip to London and you're like, I must buy a property. And you arrive there, you've got 3 days and you're like, I'm going to buy a property. And you run around talking to the estate agents and you just buy whatever they tell you to buy. Now, with all due respect, could someone from Cape Town, forget England, Cape Town, come to Johannesburg and in 3 days, with no knowledge and no partners on the ground, buy a good property? Yes, no? So why do we think that we can fly from South Africa to London, Sydney, New York, and everywhere else and buy good property within 3 days? You think I'm joking? We meet people virtually a couple a month that are flying to some destination to buy a property and they generally give themselves about 3 days. So that's the first reason people lose money. The second reason is they don't have the right information. The guys on the ground, the estate agent on the ground is quite happy to tell you whatever you want to hear. Because at the end of the day, they're going to sell you the stock that they can't sell to a local investor. You don't have the right partners. I think that goes without saying. You don't understand the cash flows and the management. Unfortunately, a lot of people go in. There's examples of South Africans that bought in England, not in London, but outside of London. And they promised great things on, on paper. But actually, if you knew the fundamentals of what is happening in terms of supply and demand, there was going to be, it's going to be very difficult to rent the properties. And then you've got large vacancies. I met a guy yesterday that's got 3 properties in the northeast of England, and he says on paper the returns are wonderful. In the bank, he doesn't get anything because of the vacancies and maintenance and all that sort of rubbish. So you need to understand the actuals, not just the paper returns. I believe this is a big one, working with local and international companies. Particularly in Australia, we come across this all the time. An Australian estate agent flies over here with a suitcase, they rent out a hotel room, they have one-on-one meetings, they sell you property and they piss off with their suitcase. And then once you've bought the property, try and get hold of them. Big thing for us, we're on the ground. I always say facetiously, you can come and hit me with a baseball bat. We're here. In fact, my house is about 1K from here. Our office is just over the hill. And that for me is important. Plus, we've got the guys on the ground. Underestimate the after sales and the costs. I think that goes without saying in terms of the information. And lastly, I learned a huge lesson in 2008. I bought 2 properties in England, in London, off plan. And I went to Barclays Bank. Let's just, for argument's sake, say Neil is Barclays Bank. I got a complete pre-approval. I got it in writing, and they agreed that they would finance my transaction. Now, we knew that it was a 70% loan to value, so I had to put my 10% deposit down, and in 2 years when the property transferred, I had to put my other 20%. That's fine. I planned for that. But I had a writing from Barclays Bank that they would, honor the loan. Now, we had the global financial crisis. 2 years transpires, and what do you think Barclays Bank did? Sorry for you. Now, we ran around. It was an absolute flipping nightmare because I've got 10% tied up, £40,000 plus minus. And if I don't get my 70%, it's irrelevant because I've got the 20 but not the 70. So we had to run around. We got financing for a couple of clients through Bank of Nigeria. I didn't think that would be possible, but it actually happened. And the biggest lesson I learned from that is that I don't invest in off-plan developments anymore. The reason being, they're too risky. I don't know where we're going to be in a year's time. I don't know where we're going to be in 2 years' time. I like to buy a tangible asset right now. I can see it. I can finance it. I can collect my rent. I know what I'm getting. I know what the quality of construction is going to be. Because the other thing is, and it's unfortunately a big problem here in South Africa, is that what you see in the picture and what they deliver is generally very different. I know there's some developers in the room, including my personal friend, but an honest developer, that's an oxymoron. So there's actually a report which is on your USB for all of you, and it's the 6 things you need to know before you invest offshore. It's on your USB. Whether you invest with us or not doesn't bother me, but please make sure you read that report so you don't join the other 80%. And then lastly, one that's very important for us as South Africans is the currency devaluation. Our inflation rate in South Africa, the 10-year average is 9%. We're currently sitting at 5.5, although it's starting to push higher towards 6. The American 10-year average is 3%. It's currently sitting at about 2%. So that's the economic fact. Can we agree that it's economics 101? If our inflation is higher than someone else, our currency has to devalue over the long term. It's economics 101. Then obviously we've got the sentiment side, whether it's the OECD, Zuma, Kasatu, George Soros shorting the rand. It doesn't matter. They're playing up and down and manipulating the rand and where it's actually going. I did research in 2011. 90% of middle and upper class people in Zimbabwe, Argentina, and Russia were directly impacted by currency fluctuations. What did the other 10% do? Pardon? They hedged? They invested elsewhere? To be honest, ladies and gentlemen, they didn't even necessarily have investments. They might have just had money in the bank. Let's look at the research and the impact that this has. I haven't done this for America because the research for the whole of the American market is actually quite difficult to find. But for Australia, if you look back here, back to 1978, that's as far back as South Africa and Australia go, and you take the ABSA housing index and you take the Australian housing index, and you take into account capital growth, inflation, exchange rate, return. Basically, if you invested the exact same amount of money in Australia in 1978 and the exact same amount of money in South Africa, today in South Africa, you'd have net asset value of about R1 million. In Australia, it would be about 3.5 million. It's about 350% or 3.5 times. Now, people say to me, Scott, I'm in Johannesburg, I understand the market here, and I can make fantastic returns in Johannesburg. And I go, I agree. It's an emerging market, there's great opportunity, you understand the risks, you understand how to manage the risks. And therefore, it's a great opportunity to make money here. I believe it's much easier to make 9 rand than to make $1. However, if you're taking a 5+ view, you have to take into account the long-term stats as to what is actually happening with regards to your wealth. And my marker is that we need to value our wealth based on global wealth. Because at the end of the day, it doesn't matter how wealthy I am in rands. If I don't have access to US dollars, Aussie dollars, pounds, etc., I don't have the freedom, going back to what I said in the beginning. Whether it's the freedom to go on a skiing holiday, or whether the freedom to send my son to Harvard. So we work a lot with this guy, James Painter. And who was on the webinar with James? Okay, for those of you on, was it valuable? Excellent. Okay, so was it good, guys? Okay, so for those of you who haven't, it's all on your USB. Go and watch it. This guy's a rocket scientist. Okay, and what I tried to do is take his rocket science and turn it into kind of simple language that I could understand. And hopefully it made sense for you. But the bottom line with him is that I don't really care when I drove from Pretoria yesterday to Johannesburg how my car works. I'm really not into that. I don't care. All I want to know is know how to drive the car. So for me, with this guy's research, if you're the type of person that really wants to go into depth and understand how he does it, he's had an accuracy since 2005 of more than 80% in terms of forecasting where the rand is going to go. That's pretty good, I think, considering how the rand fluctuates up and down. And the best way to describe it in simplicity terms is he does it just like the weatherman does the weather report. They look at patterns, and based on patterns, they can predict where we're going in the future. And that's what he's done. So go and watch the webinar. I just want to share with you the 3 fundamentals that I see as the takeaway. Firstly, since 1990 to today, which is 23 years, the rand has depreciated by 5.6% against the US dollar. Now, as you can see, we've had huge highs, we've had huge lows, we've had huge highs. You can also see the trend line, you can see the equilibrium, and you can see now that we're starting to break back through equilibrium. But most importantly, if you're looking at a return of, say, 15%, and you're getting a net return in America without capital growth, purely a net income return of 10%, I believe if you're looking at a 5-year plus view, you've got to take the 5.6% into account. I personally don't use 5.6. I just use 5 because it's the long-term trend. It's a 22-year trend. I think it's fairly safe. If it was the last 2 years, I wouldn't agree with it. But 22 years is a fairly consistent trend. And there's two other reasons why I use that. The way and the thing that is affecting, and you see, I didn't even know this until James taught us what it is. The two things that are affecting the rand most is the change in productivity and the change in labor costs. To show you here quickly, this is our trading partners here in maroon, and their change, this is their productivity, their increase in productivity. And this here is South Africa and our increase in productivity since 1981. We used to be nearly 30% in terms of efficiency. We're now at 15%. Do you think that trend's going to change against our trading partners? So that's the one fundamental that drives the rand. The second fundamental that drives the rand is unit labor cost. Look here, the blue line is South Africa. Look at our labor cost. And that's our trading partner, trading partners. Again, do you think that trend is going to change? So one thing, that the way I understand this, to put it in simple stakes, you've got Marikana, the guys want a 20% increase. The only way to give them a 20% increase is to devalue the rand so that that ounce of platinum is still costing the same amount in US dollar terms. Make sense? So those are just the fundamental three reasons. I did want to just share with you where he believed the rand was going, because I'm a subscriber to his website. All the details are on your USB. And just for interest's sake, he's actually agreed for everyone in this room to get a free month subscription. So you can actually go and check it out. Now, this is what's on your USB. Okay, so you can see everything and everyone that's going to talk today is on your USB. So it's fairly obvious, hopefully. You go into rand analysis, you go to rand forecast. So I'm not really interested in what's going to happen in the next few days. If you're investing in international property, if you basically don't have at least a 5-year time frame, then please don't talk to me. Please go and deal with one of our competitors. Because if you're investing internationally, it takes a lot of time, a lot of effort. You've got to find the right investments, and then the plan is to buy and hold. It's not to jump around and flip, and it doesn't work. If you want to do that, please go and speak to someone else. So in the next couple of days, he actually sees the rand recovering a bit and being in the target area of between 905 to 888. I drew this last Thursday, so this here is the next few weeks. He sees us moving, so it'll bounce through and go up to the next level, and we'll be between 938, I should get the pointer there. We should be between 938 and 990 in that target range. So this is the next few weeks. We're currently sitting about 920, I think. Am I right or wrong? Yeah. The next few months, we're looking at a target range of between 950 to 1030. And the one that's really important for me is that as a long-term international investor, the next few years, we're looking at between 14 to 23. Now, just in my interest, who here did stats at university? Most of you that did a finance degree. So I also did Stats 100. And I'll be honest with you, it took me quite a long time to understand these graphs. I didn't really enjoy stats. But can we agree that the only thing he doesn't know is where that's going there? Do you see there's no lines going this way? Basically, it's a question of time. That, for me, is one of the most fundamental reasons that we as South Africans need to compare an apple with an apple. So if I'm getting a great return in South Africa, fantastic, but I've got to compare an apple with an apple in terms of my long-term wealth, in terms of where I actually am. So this is Clem Santa. Everyone in the room knew him. That book is, I would highly recommend it, The Mind of the Fox. Clem talks about, and I go into this in a huge amount of detail in our webinar, and as I've said a couple of times already, the purpose of today is to give you an overview. If you want to go deeper, it's all on your USB. In this webinar, we spoke about it for 2 hours, and I know you guys are from Joburg, and so most of you haven't surfed. Am I right or wrong? But to be fair, you've probably swum in the sea, haven't you? Yeah? So I like the analogy of the sea, and if you've got the wrong flag up, I don't know, do you know what this flag over here means? Okay, just a quick tip. When you go down to Durban or Cape Town, if you see that flag, get out the water. It means there's a shark in the water, okay? And my point is, you know, once you know the flags, you can be out at backline, you can be surfing, you see the flag change, you're like, right, I need to change my strategy. Does it make sense? So what I like about Clem Santa, it's the same thing. He's got flags. He doesn't predict the future better than anyone else. He's just got flags that then change his scenarios. So he's got 3 scenarios for South Africa, and he's got 4 scenarios for the global economy. And what I did, having watched this presentation, I think 5 times, is I said, well, this is fantastic information, but how do I practically use it in terms of my own investment decisions? So I built a 4-dimensional calculator. Now, there's basically 4 dimensions to it. You've got the global scenarios, you've got the South African scenarios, you've got what country to invest in, and then you've got what to invest in. Does that make sense? Okay? And all that I did was multiply out his probabilities to give me a result. So if his probabilities change, the result changes. If you want to go into the webinar, I'll go into this in a lot more detail. But interesting enough, based on the 4 global scenarios and the 3 South African scenarios, the USA is pipping South Africa, but actually it shows you there's a good balance between investing at home and investing offshore. You've got the UK at a dismal 4th, and then you've got Australia. Now, just my interest, I've got a personal belief. If I invest out of South Africa, do I think it is clever to go from one emerging market into another emerging market? Why jump out of the frying pan into the fire? You're in the emerging market that you know, understand, and not necessarily trust, but you know how to make money here. Okay. Why go and buy in Cyprus, Bulgaria, Zimbabwe, Mauritius, emerging markets where you've got the same concerns and problems that you've got in South Africa? So for me, one of the reasons that when I say in these countries here, we only look at first world countries. And that's why we focus on the US, the UK, and Australia. Interestingly enough, we're using the same analytic tool. Property at the moment, depending on all the different scenarios, is number 1, stock market is number 2, gold is number 3, and the bank is number 4. So just the question that a lot of people ask is, well, what do we do? So I told you there were 3 scenarios for South Africa. The first one's Premier Division. Based on the Premier Division and based on the 4 global scenarios, the US is just pipping South Africa, the UK 4th, and Australia. In the second division, because South Africa, you can actually see that South Africa drops down. There's still opportunity in South Africa, but the US, in terms of the opportunity, increases, the UK and Australia. And under failed state, South Africa drops away. You've got the US, Australia, and the UK. And as a balance of investment, if we're in the Premier League, you could be looking at maybe a 70-30 split. If we go into the second division, it could even be a 50-50 split. And if we go into failed state, it would be a 20-80 split. The one thing Clem Santa said, and there's no science behind this, it's literally like, Neil, you don't need to answer this question, but it's like, how confident are you in the future of South Africa? So I would say I'm 70 to 80% confident, which means I should have 70% of my wealth in South Africa, and I should invest 30% overseas. We've got some guys in Pretoria that are 100% negative. Fine, 100% overseas. Do you see where I'm coming from? So it's very subjective. The thing that's very interesting for me, who here read the article in The Economist in 2006 that said that the property market around the world was going to crash? Did you read it?
Yeah, I read basically the analysis.
So in 2006, The Economist told us the property market was going to crash, and everyone poo-pooed them. They gave all the research, they said why, and to be fair, we thought they were smoking something, but they were right. Yes, no? They've got an article there, it's on your USB, it came out on the headline of The Economist, about why America is the opportunity at the moment. They call it the big long. It's not going to happen overnight, but it's got a long, sustainable future in terms of what's happening, in terms of where the market's going. They've also got this research, which I think is invaluable. They've got the top 20 property markets around the world, and they've got the affordability of those property markets based on price and income. Now, for me, this is really important because I don't have to go and do 20 years worth of research. They've done it for us. And the 2 markets that they believe are the best and most undervalued are Germany at minus 20% undervalued and the United States at minus 19%. You'll actually see I haven't included Japan there at minus 36%. I don't speak Japanese. Their population is in decline, and I'm not even interested in it. We have actually analyzed Germany quite extensively. I personally think that Germany, although it is the jewel of the European crown, it is still in Europe. It is still tied to the euro. It is still tied to sovereign debt. And the biggest thing that I've got a concern with in Germany, actually, is it's very socialist. 70% of properties in Germany are actually are rented. Okay, and they've got rent controls and a whole bunch of other things in place that I don't like that from a capitalist investment perspective. America, minus 19%. Just a matter of interest, England, 20% overvalued. Australia, even overvalued, according to them. And then lastly, I wanted to share with you this tool. I think this tool is so cool if you are trying to decide where to invest and to look at different markets. But if you go into The Economist, I've given you the link, it's on your USB. But check this, if I want to compare the different markets, so I can click on Australia, I've got the US, and I want to do South Africa. Anyway, while I'm pulling that up, the beauty with this calculator is that it's got 5 different things. It's got price based on price growth, it's got price based on income, it's got net returns, it's got everything that you can do if you want to compare the different property markets. And it goes back as far as 1975. So literally, you want to be an expert and compare the top 20 markets in the world, you've got the tool. But there's one overwhelming thing when you look at research back to 1975, and that's the fact that the American market is the most undervalued market based on real terms, based on income, based on yield, based on any one of the 5 metrics that you want to look at. So what I tried to do with Clem Santa was to say, listen, if we're looking to invest internationally, because the world is going global, it's become a small village, how do we decide where to invest? And to be honest, we came up with a global property system. Now, when I created the system, and Neil will know exactly the story, I was a little bit embarrassed. Have you ever created something and you were a little bit embarrassed, like you didn't actually know whether it was good or bad? Yes, no? So like, I did this event with Neil back in September with Clem Santa, and I kind of snuck up to him, a bit embarrassed. I was like, dude, I've kind of built this model thing, and you probably won't like it, but if you want to just take a look at it. If you've ever dealt with Clem Santa, he's one of the nicest guys on the planet. And he was like, sure, I'll look at it, no worries. So that was the Tuesday. He looks at it. On Thursday, we had the JHB event, and I was like setting up my computer or whatever, and he walks up to Neil and he says, wow, I met this young guy on Tuesday, and he's got this incredible model. Like, where is he? I was like, that's me, dude. Anyway, my point is we then went and did a whole webinar about it, and we're now writing a book about it. But my point of why I'm saying this is that there's 4 fundamental things that you need to look at if you're trying to invest in international property. The first one is your economic risk. What is the risk in the country? And this is based on hard facts. It's based on Clem Santa's scenarios of both the global and the South African scenarios. The second one is the value of property. So can we agree, one of the reasons I'm not investing in London right now is that the London market, at the back end of 2008, after Lehman Brothers, it took a big hiding of about 15% to be exact. And from October 2008 to June 2009, there was a great opportunity in London. But what happened was there was more demand than there was supply. There was no supply coming into the market. And so within 12 months, they sapped up the inventory. The prices recovered within 12 months by 17%. And since the end of 2009, prices have actually ticked higher and higher and higher since the crash. So for me, the challenge I've got in London right now, and you must understand, I own a number of properties in London. I'm not selling them. I think it's great to have property. I just think to buy right now, there's too much risk for me because I'm buying it at full market value when all the risk is still there. The sovereign debt, the fact the British economy is in recession, it's tied to Europe, etc., etc., etc. So that's why the value of property discount is so important, because in comparison, the US might also have structural problems, but I'm buying property at 50% below value. Make sense? Population growth. This is primarily from Dr. Dolf de Roos, and he says the number one fundamental, if you want to know which markets are doing well or bad, is population growth. Place like Japan, 20 million people have left, or whatever, their population declined by 20 million. Their property market has been stagnant since the late 80s. Places like Australia, America, South Africa, the population growth is good, and therefore it's to our advantage. Places like Ireland, just as an example, the next one, if you take supply and demand, in Ireland at the moment, 1 in every 4 homes is standing empty. Now, is the market going to recover quickly with that? Can you pick up a really discounted holiday opportunity? Of course you can. But don't kid yourself that you're going to be able to rent it quickly and have a decent investment return. So for me, supply and demand is fundamentally important. And if you knew that in 2004, 1 in every 4 homes in America that was built stood empty, would you have been able to foresee the future? Yes, no?
With the population growth, you had better prospects for
You've got population growth, you're right. But the bottom line is they're building more houses than there was demand by 25%. And when you've got that fundamental problem, it will cause chaos later down the line. And we all saw what happened. So that's why supply and demand has to be taken into account. And this is the third pillar, and we put them in a 60-40 weighting. And the fourth one is the rule of law. Now, why is rule of law important? Anyone want to venture a guess? Management? Protects you when things go wrong? Managing risk. You know, for me, if you look at India, India will give a perfect score. Yes, 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 yes. But the fourth one, no. Anyone who knows, I've done quite a lot of research into buying in India because I think, right, we've got population growth, we've got economic growth, we've got supply and demand, we've got all the fundamentals. But do you know that in India, if you buy a property, even the Indians that I know, because only Indian nationals can buy property, even the Indian nationals that I know that buy property just hold it. They don't even put a tenant in it. So they only rely on capital growth. Now, for me, that's ridiculous. That's not an investment. They might as well buy gold. Make sense? So that's why India gets a low rating on that one. And then, so this is the X quadrant, and this is the Y quadrant. And the biggest lesson I learned from the global financial crisis is that those people that focus on income not only survived, but thrived. And those people that focused on capital growth took a hiding. You know, for me, if you focus on capital growth only, it's like betting against winter. It will come. So we put it on a, you've still got to take into account, but we put it on a 70-30 rating in terms of importance, income being 70 importance. And what that basically allows us to do is to compare different countries. And you'll see here, we've got low return, we've got low risk to high risk, we've got low return to high return. It gives us 4 quadrants: low return, low risk, low return, high risk, high return, high risk, high return, low risk. Now, purely based on facts and stats, at the moment, the US is sitting the only one in that quadrant. Australia is sitting in this quadrant, the UK is bridging the quadrant, and the rest, unfortunately, are sitting in low return, high risk. Now, you might disagree with me. You might say, hang on, Scott, you're talking rubbish. South Africa has no political or economic risk. The properties are actually at a 50% discount. The population growth is at 100%. The supply and demand, or sorry, no, the whatever, it's at 80%. And most importantly, there's no rule of law problems at all in our country. And you see that I'm just playing with numbers, but it immediately shifts the variables. So it's just a tool. You know, the biggest lesson I learned from Robert Kiyosaki when I read Rich Dad, Poor Dad many, many years ago was that you need to have a framework. And then as the variables change, you use the framework to make different decisions. Now, will America necessarily be the best place to invest in a year's time? Yes, no? Who knows? Who would be interested, as I said to you, I'm writing this book and Clem has agreed to write the foreword and everything else. Who'd be interested in getting a copy? Lekker. We'll send you one. I'm going to Neisner for 2 weeks in April and I'll finish it off. I believe basically to understand the future, you have to understand the past. So for me, there's 2 fundamental things that happen in America, and we need to understand what they are that caused the chaos to then understand why we can rely on the future, or at least predict the future. Does it make sense? So the 2 things, the very first one is the subprime crisis. Now, we all know about the subprime crisis, but does anyone know what caused the subprime crisis? Anyone? Reckless lending?
The kicking of the interest rate after 2 years, I think
Perfect.
adjusted rate mortgages.
Perfect. This man's 100% right. So it was reckless lending, but to get into the dynamics of that reckless lending, it was actually what they did was that I would come along to Gary here, and I'd say, listen, Gary, do you want to buy a lovely house on Mount Street? It costs 10 million rand. I know you only earn 10,000 rand a month. Don't worry about that. You just have to give me a stated income telling me you earn 150,000 rand a month. You just sign the form. You don't have to prove anything. Just sign the form. It's called a stated income loan, and then literally I'll give you the mortgage. We'll do it. We'll fix it at about 2 to 3%, and we will, as you said, it'll be fixed for 3 years. Cool? So off I go. Now, if Gary was intelligent, hopefully he would go, but hang on, what happens after 3 years? Okay. And what I would say in that situation is, dude, the market's going through the roof. The prices would have gone up. We'll just remortgage the property, get you refinanced, and you'll be fine. It didn't happen like that. It's exactly as this gentleman said. What happened was after 2-3 years, they came to the end of their fixed period. The property market had started to go down. The banks couldn't refinance. And suddenly Gary's mortgage jumped from 3% to 7%. Now, what Gary did is that he's got non-recourse lending, which basically means they can't come after him. They can just come after the property. So he just put the keys in an envelope and he posted them to the bank. And it's called jingle mail because it jingles when it arrives. And these were the reset mortgages. That there is actually Lehman Brothers. Now, I know this graph is out of date, but it tells us what we need to know. The interesting thing is that this is all the residential mortgages. This light blue line here is $1 trillion of unsecuritized commercial debt that is on 5 to 7 year fixes. So we're going to talk a lot today about whether we should be investing in residential or commercial. But you need to know about this. Now, granted, the government and everyone's working tirelessly behind the scenes to make sure that we don't have the same collapse that we had on this side. But you need to know that it's still there. Someone, I don't know if you've heard of the term, but basically they used to give out ninja loans. No income, no job, no asset. This year, the second major problem was supply and demand. So we've got the huge growth here. And at the peak, there were 10 million homes oversupplied in America. And then, boom, the crash, 40%. And then for 5 years, we've bumped along the bottom. And interestingly enough, one of the gentlemen mentioned it, we've had population growth. The American economy the American population continues to grow. So what's happened is that over time, also because prices have come down, they've started to absorb the inventory. And we started to reach that threshold now. I would say the bottom of the market was probably the last quarter of 2011, plus minus. Now, the only time you can ever call the bottom of the market is with hindsight. Okay? But definitely, having gone to America 4 times last year, the sentiment has turned. Things are definitely starting to move. The inventory is now at its lowest levels, and I'll let the partners talk about that. But definitely, it seems to be kicking up off the bottom of the market in terms of where we are. The stuff for me that's important is that I believe all property should be based on income. This is the long-term trend line. You can see the prices based on income and how they were hugely overvalued, and now they're back in equilibrium in terms of the long-term trend line.